Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SemiLEDs Corporation quarterly report. SemiLEDs Corporation market capitalization of $0 billion is materially smaller than most of its industry peers of roughly $27 billion. SemiLEDs Corporation trades at a higher price-to-book ratio of 5.85 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit financial flexibility and increase risk during economic stress. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. SemiLEDs Corporation offers a diverse range of businesses and services that cater to various industries. The company develops, manufactures, and sells LED chips, components, and modules, as well as systems, both domestically and internationally. Its product portfolio includes enhanced vertical LED products in different colors such as blue, white, green, and UV. In addition to its core offerings, SemiLEDs also provides LED chips to packagers or distributors, and lighting products to original design manufacturers of lighting products and end users of lighting devices. The company's products are used in various applications, including general lighting for commercial, industrial, and residential purposes, as well as specialty industrial uses such as ultraviolet curing, medical/cosmetic treatments, counterfeit detection, and germicidal/virucidal devices. Furthermore, SemiLEDs products are also utilized in horticulture, architectural, and entertainment lighting. The company's extensive product range and diverse customer base demonstrate its ability to cater to a wide array of industries and applications. SemiLEDs Corporation's stock price has seen a notable surge of 32.89% in the past year, driven by two key events in the first half of 2025. The company's financial results for the second quarter of fiscal year 2025 were a significant contributor to this increase. SemiLEDs reported a substantial revenue jump to $10.9 million, a marked improvement from the previous quarter's $1.3 million. Moreover, the company returned to profitability with a net income of $388,000 and saw its cash and cash equivalents double during this period. The launch of the world's smallest PPG sensor head by SemiLEDs Corporation, a subsidiary of SemiLEDs, in collaboration with SemiLEDs Corporation, was another major factor behind the stock price increase. This innovative device boasts a miniature size and is poised to open up new market opportunities for the company. The introduction of this product signaled potential technological advancements and growth prospects for SemiLEDs. While subsequent financial reports presented a mixed picture, these two events are identified as the primary drivers behind the significant stock price increase over the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. On the positive side, revenue growth is primarily driven by significant increases in buy-sell purchase orders of equipment, which accounted for 51% of revenues. This trend continued into the second quarter of fiscal 2026, with $1.3 million in revenue generated from these orders. Additionally, other revenues saw a substantial increase of $1.3 million, 217% change, contributing to overall growth. On the other hand, revenue decline is attributed to several factors. A decrease in revenue from $11,302 to $10,246 was observed, with cost of revenues increasing by $4,000, from $8,000 to $12,000. Furthermore, a significant decrease of $60,000, 92% change, was noted in LED chip sales. The mixed or unclear category highlights various factors that may impact revenue growth. These include the introduction of new higher-margin products, steady growth of module products, and continued commercial sales of UV LED products. Industry growth, demand for products using LEDs, average selling price of our products, changes in product mix, ability to reduce costs, product innovation, government regulations, general economic conditions, competition from Chinese manufacturers, concentration of sales in a few select markets, and fluctuations in customer demand are all potential drivers or inhibitors of revenue growth. The net income of the company experienced a slight improvement between 2024 and 2025. While the exact numbers are not provided on page 25, the data from page 7 shows that the loss decreased from $2.9 million to $1.6 million over this period. However, profit margins tell a different story. According to page 25, they declined significantly from 21% in 2024 to 1% in 2025. This decrease is attributed to various factors, including reduced average selling prices, changes in product mix, underutilization of manufacturing capacity, and high fixed costs. The improvement in net income can be seen as a positive trend, but it is overshadowed by the decline in profit margins. The reasons for this decline are multifaceted and indicate potential issues with the company's pricing strategy, production efficiency, and cost structure. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash provided by operating activities has increased to $361, marking a positive trend. This increase in operating cash flow is a crucial indicator of the company's financial health and stability. It suggests that the business is generating sufficient revenue to cover its expenses and invest in growth initiatives without relying on external financing. As a result, the company is better equipped to meet its short-term obligations and navigate any potential challenges in the market. The positive operating cash flow also provides the company with greater flexibility to pursue strategic opportunities and make investments that can drive long-term growth. Overall, this development is a testament to the company's financial discipline and ability to manage its resources effectively. The company's debt level has remained relatively stable over the past few years. According to the extracted summaries, long-term debt decreased from $434 to $308 between two unspecified time periods, but then increased slightly to $1.7 million before decreasing again to $1.6 million on page 25. By August 31, 2025, the debt level had stabilized at $800,000. In terms of interest expenses, there has been a significant decrease over the past year. Interest expenses net decreased from $67 to $12, representing an 82% decrease in interest expenses as reported on page 25. Additionally, cash paid for interest was $0 in 2025 compared to $13 in 2024, indicating that the company has made substantial progress in reducing its interest expenses. Management is optimistic about the company's outlook, citing several key strategies that will drive its success. In the short term, the company expects to generate revenue from existing purchase orders and reduce manufacturing costs through technical capabilities. In the long term, management plans to focus on developing new products and technologies, including multi-pixel mini LED packages and small-format AI sensors. This strategy aims to innovate and offer competitive products that meet customers' specifications and pricing requirements. To achieve these goals, management is prioritizing several key strategies. These include improving liquidity, reducing costs, introducing new profitable products, and expanding sales and distribution channels. Additionally, the company believes that industry growth will continue to expand the market for LED lighting, positively impacting its financial performance. The company made significant moves in terms of its financial transactions through acquisitions and divestitures. In the fiscal year 2025, the company acquired equipment, marking a notable investment in its operations. In addition to acquiring new assets, the company also engaged in divestiture activities. Notably, it repaid loan principal by delivering shares to Simplot Taiwan Inc. and Trungdong totaling $1,200,000 and $400,000 respectively. This strategic move allowed the company to manage its debt obligations effectively while maintaining a strong financial position. The company's financial history reveals a notable trend. One significant aspect of its operations is the payment of dividends to shareholders. This indicates that the company has prioritized returning value to its investors through regular dividend payments, demonstrating a commitment to shareholder satisfaction and wealth creation. By distributing profits in this manner, the company aims to maintain investor confidence and loyalty, while also providing a tangible return on investment. Concerns about inventory buildup or supply chain disruption are evident in the recent data. Inventory levels have increased, but this growth is accompanied by a significant rise in provisions for inventory write-downs, indicating potential issues with excess or obsolete stock. The decrease in accounts payable from 2024 to 2025 also suggests that suppliers may be experiencing difficulties in getting paid on time. The risk of inventory buildup or supply chain disruption is further highlighted by the mention of excess or obsolete inventory due to loss of suppliers or contract manufacturers. However, a closer look at the data reveals some inconsistencies. While purchase obligations remained relatively stable between August and November, inventory levels decreased during this period for raw materials, work in process, and finished goods. Despite these fluctuations, the overall trend suggests that there are concerns about inventory buildup or supply chain disruption. The significant increase in provisions for inventory write-downs and the decrease in accounts payable indicate potential issues with excess or obsolete stock. These concerns warrant further investigation to ensure that the company's supply chain is functioning smoothly and efficiently. That concludes the financial summary for SemiLEDs Corporation. Feel free to comment below, and I will be happy to answer them when possible.